Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures.
There was a story on Bloomberg earlier this week that basically quoted a bunch of CEOs as saying, if we don't see the Fed start to act quickly and act aggressively, we're going to lay off more people.
The Federal Reserve has kept rates unchanged today. The markets are up dramatically. Stocks are up. Gold is up. Bitcoin is up. So let's interpret what happened today with our next guest, Danielle DiMartino Booth, CEO of QI Research. Welcome back to the show, Danielle. Always good to see you.
Great to see you, David. How are you this afternoon?
I'm very well. Markets are doing well as well. Let's recap some of the things that Jerome Powell has said and get your outlook on not just Fed policy, but also update us on your economic outlook as well. A lot of data points coming out this week as well. So I want to play for you a few clips, starting with this one. Take a listen here.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not? Or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way.
He's okay with a little bit of cooling, but he needs to see material cooling. Are we going to get material cooling? That's my question, Danielle.
So, there's a little bit of irony here, right? In that we had Intel, which has received a $7.9 billion loan from the U.S. government, announced 10,000 layoffs the night before the Fed meeting. I think that we are seeing a material cooling. At another point in the press conference, he mentioned that layoffs weren't up. Well, I mean, I guess it depends on who you're listening to. Another reporter asked him about, are you not listening to what corporations are saying? Because clearly they are out front and center in terms of reducing their headcount. And he kind of wavered around, danced around that question. So, this was a very painful press conference to watch. And he seemed like he was, painfully measured in so many of his responses. It's not too hot. It's not too cold. It was all Goldilocks, but he seemed to be very uncomfortable in his skin today.
And what strikes me as interesting is that a reporter asked him.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned, we think that the time is approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
A lot of ambiguity. What's your interpretation?
So to me, at least, the most intriguing answer that he gave at the press conference today was that they had a nice conversation, quote unquote, about whether or not there was going to be a rate cut at this meeting. So even though we went in with only a 3% probability of a rate cut, it's clear that even though you see the unanimous decision, there were no dissents. But if they had, a nice conversation about whether to cut today, it seems to be somewhat disingenuous to me that September is not kind of the underlying assumption going forward, given some members of the committee clearly felt that today they should have started cutting rates.
Why do you think risk assets that moved up, not just risk assets, gold as well on the day?
So you're seeing what you're seeing right now, David, I think is a ton of correlation. The one market you did not mention is the bond market. And you saw the 10-year yield close at 4.07%. And that was a massive rally from what it was going into the FOMC. And you saw reversals in quite a few of the markets as well off of their highs. So I think that financial markets right now are demonstrating a tremendous amount of cross currents. You're not just seeing great big up days like you saw today. You're also seeing large down days. So the volatility on a day by day basis is really tremendous. I'll be really intrigued to see how markets behave tomorrow, because it's as if every day is a brand new trading year, not trading day.
Okay. He was also asked if he sees any higher chances of a hard landing happening now at this point. And he said,
I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, a good labor market and inflation coming down.
Do you agree?
I think that is, at this point, I think it's difficult to make the case that we're not potentially in recession or have been in recession, given the magnitude of the revisions that we're seeing and the abruptness of the slowdown. You're seeing, for example, construction job openings have absolutely collapsed. That's been one of the pillars of strength in the current post-pandemic economy. You're seeing professional and business job openings truly collapse. So ADP came in weaker than what was expected. The chief economist at ADP said, if you're looking for a source of inflation, it's not going to come from wages. So when individuals who are potentially, David, a little bit more balanced in their commentary than I am, I say it like I see it. You have to start wondering if and how the Fed has as an assumption no hard landing when the data are turning so hard.
Despite the ambiguity at the press conference today, the CME Fed Watch tool still maintains a very high probability of a cut by September. 85.5% chance is currently the reading as of now, right now, 4 p.m. Eastern time. Ultimately, then, do you agree?
Oh, I think that given the momentum that we're seeing in the data right now, I don't foresee that in the next 7 weeks, there is not compelling additional, because he kept saying he wanted to see more evidence. I don't think that we're not going to see the evidence that he's looking for. I think that by the time September rolls around, even though he absolutely denies the possibility of a 50 basis point rate cut in September, I think that probability will continue to grow.
Well, that does raise the question, going back to what the reporter asked him, why not just cut now? There are long and variable lags, as they've stated many times. And, the assumption is that this is headed in the right direction, inflation, unemployment. Why not cut now?
Why not cut now is right. When you've got so many companies that are reporting their earnings and at the same time reporting headcount reductions, I'm sure that there are a lot of CEOs who are saying the same exact thing. In fact, there was a story on Bloomberg earlier this week that basically quoted a bunch of CEOs as saying, if we don't see the Fed start to act quickly and act aggressively, we're going to lay off more people. And these are just, CEOs are saying it like it is. We're not necessarily seeing misses in profit, but we are seeing a higher preponderance of misses in revenues. And that's the one thing that CEOs cannot cover up.
Yeah, and Powell alluded to the balancing act that the Fed has to do all the time, which is to say that if they cut too soon, they may risk inflation ticking up. And he mentioned that inflation was, cool for one quarter, but we saw an uptick last year. But then on the other hand, if they don't cut, whatever scenario we're talking about now, which is not good, could happen, right? So where do you stand on this balancing act?
Look, I follow Truflation fairly closely. I talk about it a lot. It's got a 97% correlation with headline CPI. We've seen a dramatic decline just in the last few weeks. It came in at 1.51% today. The disinflationary winds are blowing hard. We saw a surprise downside in home price appreciation as well. We're seeing a rapid build in inventory. Of course, shelter's the largest component of the CPI. There are ways that you could foresee, even though we've got tougher base effects going forward with the next three CPI reports, PCE reports, there is the case to be made for shelter coming down so quickly that the Fed's going to see, that Powell's going to see the additional evidence on the inflation front that he seems to be looking for.
Can we go back to the collapse of businesses that you were alluding to earlier? So suppose rate cuts don't happen. What's the likely scenario here?
I mean, you have a lot of companies throughout corporate America that are leveraged up to their eyeballs. And the more companies that are forced to go into the market and refinance with these stubbornly high interest rates, the more bankruptcies you're going to see, the more closings you're going to see. Separately, we have the National Retail Federation come out and say that most major U.S. retailers had brought forward by 3 months their holiday purchases, and that pushed up freight costs to a great extent. If the U.S. consumer does not come through with increased spending, which is not what we're seeing, then you're going to also see a continued liquidation in the U.S. retail sector.
Danielle, what's your take on inflation overall? Where's it headed from here?
I think inflation I think inflation is beaten. I really do. When you are seeing wage inflation metrics, including the employment cost index, the Fed's favored metric, begin to come in below expectations, I think that is telling you in no uncertain terms, because wage inflation is the most lagging of all types of inflation. When you're starting to see wage inflation come down at the pace at which it's falling, that is telling you the direction of inflation going forward.
And Powell hinted at the fact that this is an unusual time.
We raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress in the labor market, as I think, unemployment was in the mid threes. So it's a different economy. I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve.
So you've got the Goldilocks scenario of lower unemployment and lower inflation. Is that correct? Is that the correct assessment of what's going on right now?
I'm going to have to push back against his Goldilocks scenario. You're seeing underemployment rise appreciably. You've seen more than 1.5 million full-time jobs lost in the last 6 months. And I dare say that people who are working part-time instead of those full-time jobs that they used to have would beg to differ in terms of this being a Goldilocks scenario. I took an Uber to the airport yesterday and had somebody again, and this is the third or fourth time this has happened this year, say, "You're my first Uber ride ever." It's clear that Americans are trying to make ends meet however they can, and that they don't see a Goldilocks scenario in front of them.
What's going to happen to the long-term long-term interest rates? So the 10-year, 30-year, are we expecting this decline from 4.7% earlier in the month to continue?
4.7% to 4.07%. And what the bond market is telling you right now is that, again, when you look at long yields especially, that is a gauge of the slowdown in the economy. And the dramatic decline that we've seen in yields is telling you that today should have been the day that the rate cuts began, not 7 weeks from today on September the 18th, but today.
Suppose we have what the markets are expecting, a rate cut by September. Is that still enough to alleviate the stress on corporations, the CEO's concerns, like you mentioned?
I don't think a quarter of a percentage point in borrowing costs from being north of 5% is going to be influential in any way, shape, or form. I think a lot of CEOs, I think a lot of players in commercial real estate, I think they're looking for a return to the zero bound to give them the kind of relief that they need, not a 25 basis point decrease in borrowing rates.
Okay, so ultimately then, if this is not going to be enough, then we could see a further deterioration of the economy. Is that what you're saying?
I think that's what corporate America is saying, not me.
Okay, all right. So then the Fed's going to have to respond to that further? So basically more rate cuts in 2025?
I think more rate cuts in 2024. He said that the Fed is apolitical, that every single meeting is a live meeting. He's consistently maintained that stance. And if the economy is deteriorating as abruptly as what the data are suggesting, then he'll be right behind that September the 18th rate cut with one on November the 7th.
He did say that the Fed is apolitical. A reporter asked him, would you change policy depending on a Harris or a Trump win?
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Okay, but do you have any thoughts as to whether or not which administration would be better or worse for inflation?
It's very difficult to say because both the Trump administration and the Biden administration, and presumably the Harris administration, would be spending quite a bit on social spending. If it's a Trump victory, then you're going to see an extension of the tax cuts. We just crossed the $35 trillion line in terms of the nation's debt. I can only see that going up, but the question will be what form that stimulus takes or doesn't take. And David, that comes down to the construct and the makeup of the Congress.
We have a few minutes left. Now, can you describe a scenario or imagine a scenario in which the Fed does not cut by September? So basically, contrary to current market expectations, what would that be?
That would be, as I mentioned earlier, the base effects. So you're going to have a harder time going forward seeing a falling inflation rate simply because of where inflation was this time last year, for July, for August, for September, for those prints. If they were to see a dissipation in the decline in inflation, even if it's based on technicals and not based on real-time inflation metrics, then you could possibly see that scenario playing out where they did not cut interest rates on September the 18th. But again, I think if they were discussing today, if they had a real conversation about cutting interest rates today, you're going to start seeing dissent in the ranks.
Could you start seeing more volatility in the equity markets later this year?
More volatility? I think we're seeing a ton of volatility right now. I mean, you've got the NASDAQ up 400 points one day and down 400 points the next. I think we are seeing volatility in the markets. Okay.
And that's going to exacerbate, you think, because of Fed policy, or no?
I think that if Fed officials continue to be tone deaf, that's going to manifest in more volatility for the financial markets.
Okay. Could you finish off on some asset allocation strategies for us, given your outlook?
I don't think that the Fed is going to be able to stay on hold in September, and the equity markets tend to correct once you see that first rate cut. So from an investor's perspective, they need to be very much in touch with their risk appetite and whether or not they want to be hedging their positions at this point.
Historically speaking, rate cuts, good or bad for equity markets?
Historically speaking, rate cuts themselves are what trigger true corrections in the equity market. That's just looking at history. We've seen a 10 percentage point rise as of April in the number of unemployed Americans. On average, in the post-war era, once you cross that 10% line, you see a 24% decline in the 10-year benchmark yield, and you see a 33% decline in the S&P 500.
Very good. Thank you for your update today, Danielle. Where can we follow you?
If you don't already follow me on Twitter, I'm about to cross that 300,000 mark. So please follow me at DiMartino Booth. And please come to my Substack, dmartinobooth.substack.com. We publish every trading day of the year and would love to have new readers and grow the QI research community.
All right. We'll put the links down below. Thank you very much. We'll speak again soon. Cheers.
Absolutely, David. Take care.
And thank you for watching. Don't forget to like and subscribe.